Chapter. We're talking real money.
Hello, everyone. Welcome to Talking Real Money. What do we talk about? Well, money. Really. I'm Don McDonald. Tom Cox over there somewhere. I'm pointing over somewhere and he can't even see me. We are having, well, it turns out this fits perfectly into the day I've been having all day. So it's just one
technical
more thing.
Difficulties? Is that
technical
what we're
difficulties, bizarre stuff, problems, just stuff, just things.
But we're here to alleviate your financial problem.
Not mine, but yours.
No, I have no time for that.
I have no
others.
time for that. Yeah. But here's the thing. It's really easy to get us to help. Even if the other stuff doesn't work, it should be really easy because all you have to do is call us at 855-935-8255, which, making it even easier, that spells talk, T-A-L-K. So let's talk about your money, about investing it, about spending it, about saving it, about how you earn it, how you can earn more of it, how you can invest it better. We do a lot of investing better. One of the biggest reasons why we do a lot of talk about investing better is because there's so much information out there. There's a lot of misinformation out there about investing. And one of the areas where we kind of get a little frustrated with investing is this whole concept of the S&P 500, for example. You know, people, well, if I own the S&P 500, I own the market. And one of our big concerns is that when you own the S&P 500, a very sizable percentage of your money is not in the 500, it's really in the 7. And is that a good thing? And if it's not a good thing, what should you do, Tom?
Yeah, I mean, this is an interesting time to be an investor because so many of you have piled in and continue to pile in to the aforementioned Standard & Poor's 500, the 500 largest companies in the U.S. And is that a bad thing? Not necessarily. Would it be better to be more diversified? Yeah, pretty much. It would be. And we can show you history has proven that true time and time again. But the but here is that people who tell you oftentimes you should be more diversified or you should move in and out of markets, or you should get money into non-traded assets, or you should be in private credit. It's the next thing. My friend Rich Buck used to talk about this, Rich passed away a couple of weeks ago. God rest his soul, great writer, tremendous friend. But he used to say, people can say the right thing, but it's the after the but you got to be worried about because, yes, they can say it's right to diversify, but that's the problem.
You know, and that's the big but that I don't like. I just don't like that big but. I'm not going to go to the song. Because the thing is they're often trying to sell you something, but we say but. We do too. We are we advocate not being heavily invested in the S&P 500 for that very reason. It's not that we dislike those companies. To the contrary, we think those 7 magnificent firms are truly magnificent firms making a lot of money. But because of their popularity, they may be a little oversized for the long haul. And the reason we make other suggestions is because of scientific evidence. And let me kind of go through that for you just real quickly and succinctly. Smaller company stocks, those 7 stocks are the largest. Smaller company stocks in the past have tended to provide larger performance numbers over time, as have those that are undervalued. Those 7 are not undervalued. If anything, they may be a little overvalued. But there's another thing that gets added into that formula that makes us want to keep those stocks, and that's the momentum factor. And we don't talk much about that. The fact that the things that are going up sometimes tend to keep going up, so you want to kind of keep them in your portfolio. But I don't know, to that extent, Tom?
No, not to that extent. Again, if 1/3 of your money is in 7 equities, that's too heavy for me. Jason Zweig wrote recently that, well, yeah, okay, but they have a lot of different type of economic exposures. Well, kind of.
Yeah,
they're all fairly technological. Yeah, they're all technology. the point of the matter is this, because he quotes someone in a recent article who says active managers are very good narrative creators. In other words, they can come up with great stories as to why you need to do something, why you need to change if you're just in an index fund. Continued saying the industry has had a lot of time to practice all of these effective narratives to make people believe the managers possess this magic. Don't fall for it. That's the problem there.
The thing is that active managers, like all of the rest of us, are humans, and humans are really good at telling tales. All kinds of tales, including tall ones. And that's most of the argument for active management, a tall tale. They really do have to stretch to justify their existence, and therefore the thing that they want most of all, and I'm sorry, I'm a little cynical, but what is the thing that those active managers want most of all?
Your money.
For them.
Go to break without the bed.
To make them
casualty here.
More money.
Yeah,
exactly. That's the issue. 855-935-TALK is our phone number. That's 855-935-8255. We love helping you deal with money, and this is the best time to do it because you can talk with us live every Saturday. We're live on Northwest News Radio from noon to 2 Pacific Time, 3 to 5 Eastern at 855-935-TALK, 855-935-8255, where we are talking real money.
Your guides to a really great financial future. Tom and Don are talking real money.
It looks like the little technical elves have finally worked their way into the nooks and crannies of the equipment and made it do exactly what it's supposed to do. Hello, everyone. Welcome back to the new and improved version of Talking Real Money. The previous one was, not that great.
Delete.
Yeah. Nothing a little editing can't do for the podcast.
The points are still relevant.
The points are as relevant as they ever were. The fact of the matter is that diversification is still one of the easiest ways to be a better investor long term. It really is. It's just, it takes so much pressure off of us as investors.
Yeah, and I think in the article again by Jason Zweig recently, he kind of poo-poos concentration risk. Well, concentration risk was pretty costly in the early 2000s. There were a lot of people who had piled into what they called then internet companies and really they saw a lot of their portfolio value go away quickly. And again, diversification that next decade really saved you, being international stocks and small stocks and value.
I agree. I think Jason sometimes... I love Jason Zweig's work. I really do. But like any of us, and I'm as guilty as anyone, we sometimes go a little too far for a story. And I think he went a little too far for the story in as you said, poo-pooing concentration risk, which has in the past proven to be a real problem. I mean, if you were all in railroads in the 1880s, you ended up having a problem with your portfolio when so many of them collapsed.
You literally got railroaded. But the other thing is he could have done both. He could have said concentration risk is an issue and here's how to fix it. He could have talked about being globally diversified while still picking on these beasts that are pointing out these messages like if you're concentrate, you need to get into this, you need to try this. That's the problem, into something special.
But he pulled a Don McDonald. You know how I get a little emotional about these idiots sometimes.
A little?
A lot.
A little?
Okay. Emotional about these idiots. As a matter of fact, now can we touch on you sent me a comment earlier today from one of those people.
Touch on anything you like.
Can we
don't touch anything you like? We can touch on anything you like.
Yeah,
so,
I want to do that. Should we do that later, or should we continue on this one?
Totally up to you. It's Valentine's Day. You take it at your own.
Well, yeah.
Slings and arrows, whatever.
You sent me a note from one of our listeners.
Mm-hmm. Yeah.
Because lately because of the volatility, because of the huge decline in the value of Bitcoin and other cryptocurrencies. I mean, geez, 65,000 now. Wow.
It might be 90,000 by the end of the show. It goes up and down so fast.
You sent me a written question that somebody sent in.
It's more of a statement than a question. But yes.
Well, it's a statement. Yeah, you're right. It's a statement. And I thought I just want to touch on this before we go to the phones. He said, you recently talked about how the U.S. dollar is better than Bitcoin. What if Don puts up $1,000 of U.S. dollars and I put up $1,000 of Bitcoin? In 5 years, whichever one is worth more takes it all. But then I thought about it. The only thing
that's not what we were saying.
Oh, no, hold on. I want to finish the thing.
Oh,
the only thing
me.
we know for sure is that this bet is that the purchasing power of Don's $1,000 will be significantly less in 5 years because of the consistent increase in the U.S. dollar supply. But Bitcoin is restricted by code and cannot be debased, so it wouldn't be much of a wager. Wait, hasn't Bitcoin been debased?
It has. But again, even setting that, what we were talking about was, would you rather have Bitcoin or the U.S. dollar as your currency? I mean,
right.
Do you want a currency that has gone down just roughly 50% in the last 4 months? I don't think so. Because you imagine making your payments, taking care of your mortgage, doing all that. That would be just awful, horrible, upset your life, turn it upside down in so many ways.
I never, and you never, neither of us even implied that we thought the U.S. dollar was a good investment. The U.S. dollar is not an investment.
Shouldn't be.
It really never has been. Occasionally people bet on it, but that is not what. The dollar is a means of exchange that has a relatively, though that is really a key word, relatively stable value, at least when compared to things like stocks or Bitcoin. Those don't have stable values. They make lousy means of exchange. That's what we said.
In terms of the U.S. dollar, don't let recency bias get in the way of your decisions. Yeah, it's had a tough 12 months, but really going back 25 years, it's been pretty good compared to other currencies. So I'd be careful writing it off just yet.
Well, literally, the U.S. dollar, this is what it does, okay? The dollar is the way prices of goods are set. It is the way debts are settled. It is the way taxes are paid. It is, trillions of dollars of transactions globally are in dollars each day. We don't have trillions of dollars in transactions in Bitcoin, and we have decades, dare I say centuries, of experience with dollars being a relatively good medium of exchange. We have 0 years of Bitcoin being a great medium of exchange.
I think only one country's really tried this, and now you said they've given up, right? El Salvador? Or they still...
Global medium of exchange. It is not widely accepted in trade.
Unless you're a criminal, which you can use at your own judgment.
But again, there's no, that's a silly, it's sort of a, gosh, it's a stretch, this argument. No, I wasn't saying that the U.S. dollar is a better investment than Bitcoin. I don't think either of them are good investments. I just think the dollar is a more stable store of wealth than a Bitcoin because...
which is what you want in a currency.
That's what you want in a currency. You don't want that in an investment. No, you want the investment to go up. But see, with investments, I want them to have a reason to go up. I don't want
earnings, dividends, growth, those kind of things.
Give me a story that I can tell that makes this thing make sense, that it's going or likely to become more valuable in the future. Can it become more valuable?
1 minute.
Without a bunch of other people buying it just because other people want to get richer? Can it make itself more valuable? And my answer is a company can, and they have. So.
Yeah.
Our phone number, 855-935-TALK, 855-935-8255. What do we talk about? Well, we talk about life and money and jobs and businesses and careers and the confusing world of investing and what is investing and what is not investing. And we try to do it in a fashion that makes sense for you, so that you can actually act on this. We are not speculators. We are not gamblers. We are not market timers. We are not traders, because those aren't proven ways to make wealth, build wealth. They are actually proven ways to eliminate it more than make it.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
It's a show about your dough, the Talking Real Money radio show and podcast. I'm Don. That's Tom. Thank you for being there. Give us a call if you have a question about Your money matters. 855-935-TALK. 855-935-8255. Let's go to Seattle. Mark, welcome to the program.
Hey, Tom and Tom. My question is about bond ETFs. I have a money that's in my traditional IRA that I want to use to cover years 5 through 8 of my retirement. And I have BND in some of my other accounts, so I was thinking of just doing BND. But I know that you've talked about Avantis on the equity side quite a bit. So I looked at the Avantis bond fund. I can't remember if you've discussed this in the past, but we would like your thoughts about the Avantis bond funds.
Yeah, I don't think we use Avantis for fixed income.
Dimensional, don't we?
No, well, primarily now Vanguard, I think, and maybe a little. So, but let's go back to where you started, because it's an interesting situation to say years 5 through 8, because some of the laddered stuff that just came out that we talked about recently from Vanguard and iShares, I believe, might be a good solution too, because you could say, I want this in 5 years, and you're going to know exactly the interest you're going to make on that, and they're going to give your money back and pay you the interest. So that might be a way to go. But beyond that, yeah, I mean, the thing about BND is it's a very fine exchange traded fund. We love Vanguard when it comes to most of their products, especially fixed income. It's very centered around government bonds. It does have some corporate bonds in it. Mm-hmm. It has no international bonds, which is you could.
There's an argument.
You could make a wager. Yeah, both sides there. I mean, we use a little bit for our clients, and I don't think it makes a huge difference, but you can make an argument for it. But what you might consider doing, because you are all in kind of a aggregate bond situation, is, and I don't know how big your account is maybe looking at some other type, Don, again, maybe international, maybe something else, just to give it a little bit more flavor, or maybe one of those laddered bond products that might help you down the road.
Yeah, I don't think I'd be looking at Avantis or Dimensional, because when it comes to bonds, the key to bonds is really, well, a couple of things. The biggest key is low expenses, because you're not getting much in the way of a yield from bonds. So the difference between a 0.15 expense ratio at Avantis and I think it's 0.3 at Vanguard
or less
is huge. I mean, that's a very large percentage of the pathetic little 4% income you're getting. So that is an advantage. The other advantage is their buying power. They are going to buy bonds at much better prices than Avantis or Dimensional are going to buy them. They're going to pay
This is something
less
people overlook.
And you don't
give it enough attention.
See that, but it turns out it comes out in your yield if they get a better price both sides of the trades. So this is why we love big. Big is great for bonds. Small is okay for stocks, but big for bonds is awesome. So I'm going to stick with, I think, the best bond fund in America, in my mind, is BND.
And what did you make last year? Was
and Tom, and Tom, to your point, I did use IBM P and Q for years 3 and 4, which are the iShare I bonds.
Yeah, which
so
again,
talking a little bit further out, and for BND.
Yeah, I mean, the thing is about any of this, frankly, Mark, and thank you for your call and for listening, is frankly, when it comes to fixed income, Don just said the key thing that people have, actually two things. Number one, most people overlook cost. There was a piece done in the Wall Street Journal, I think 20 years ago, that had done a study of the previous 25 years that said basically the differentiator between bond fund performance was cost. That's it. And then the other one that, again, I think is not given the credit it deserves, and that's the fact that the size of Vanguard. People don't realize there's a lot of negotiating here when they come to buying those things. Mm-hmm. And if they come in walking in the door and they're going to buy a lot, they're going to get a lot better price than I will. I can tell you that right now.
Almost $400 billion.
Wow.
Just that one fund. Now,
and is it 3/4 of it is in, or 2/3 in
3/4 is in U.S. government. That's the other thing that people, when we look, you got to delve so deeply into these things to really, particularly with bond funds, to get a really good picture. You'll have somebody like PIMCO claim with, we have much higher returns. But then when you dig deeper, you see, they have much higher returns. They have a higher expense ratio. And how do you get higher returns with a higher expense ratio? You have to reduce the credit quality of the bonds.
Yeah, you have to take more risk. It comes from somewhere.
It has to come from somewhere. There's
no other trick.
There's no trick to the bond market. There's no trick to it. You might get lucky with trading techniques, but those are short-sighted and short-lived. So if you're looking for fixed income, it's either CDs, build a nice CD ladder, or BND.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
I want to correct something. When I said 75% of BND was in governments, it's not. It's 75% is in AAA rated paper.
Okay.
Only about 52% is in treasuries or governments, I should say.
So we were right down the middle because I said 66%. So anyway,
and it was interesting during the break. I looked at one of the top, according to Morningstar, actively managed bond ETFs.
Which is?
Fidelity's Total Bond ETF, FBND. FBND.
Ooh.
Instead of 3/10, instead of 3/100ths of 1%.
3/100ths, thank you.
They charge more than 1/3%.
Wow.
And therefore, when you look at their portfolio, for them to remain competitive, you'll find that 43% of their portfolio is in governments, 67% is in AAA, and they have a lot in BBB paper. They don't have as much diversification.
What would you call BBB paper?
It is just barely good enough.
Yeah, right on the edge.
Barely,
man.
Right on the ragged edge. I mean, they have 10% of their portfolio in non-investment grade paper, whereas Vanguard's 0%.
Yeah, and this is something, again, not to be forgotten, because if you go back and look at tough times, 2008, for example, that's the kind of paper that really, you can go look it up. You can go look up Vanguard. Vanguard operates a high-yield bond fund, and it lost over 20% in 2008. Is that the kind of bonds you want to be in at that time?
And look at the diversification. The Vanguard total bond holdings, individual bond issues.
God, I couldn't even tell you.
17,500.
That's
Fidelity.
Wow.
They have a lot, but it's only 4,400.
So 3-4 times as many. Yeah. That's
much lower fee. Much safer portfolio. Comparable yields. In fact, what is the FBND yield? I know
it's going to be, let me guess, it's going to be right around 4. Like everything else in the world today, unless you're special and you're buying things that are riskier.
Yields for these anymore.
You got to go to the website.
You got to go. Yeah. Let's see. Fidelity total bond yield is where the heck's are they? Everybody's hiding the yields these days.
I can guarantee this. They're both around 4%.
Yeah. Vanguard's is 4.19.
Yeah. I think we talked about that recently.
Oh, okay. 4.43.
Okay.
For Fidelity.
As you would expect.
Slightly higher yield.
Yeah, exactly. Yep.
Substantially higher risk and higher fees.
And this is the thing, again, if I was putting together a portfolio, that should not be overlooked, because what you really want that fixed income for there is cushion. Because when stocks, and they will, go down 30, 40%, you want those bonds there to be, and if you're in riskier bonds, the prices of those will go down as well.
As a matter of fact, all the research shows that junk bonds, high yield bonds, perform more similarly to stocks than they do to investment grade bonds. So
total agreement. And what is with Seattle? I mean, here's the thing.
What's with
when
Seattle?
Was ever the last time we started a show off with a bond question? Nobody calls about bonds. I mean, they all still hung over from the big parade this week, or what's the deal?
Yeah, it's Valentine's Day.
Hanging out downtown.
You know, they're loving their bonds. 855-935-TALK is the phone number to call on Saturdays to talk with us live on the show. The other times you send questions in at talkingrealmoney.com. Although, if you're going to send questions in at talkingrealmoney.com, wait a couple of days. It'll be easier in a couple of days.
I was just waiting for this.
Right now, somebody messed with the form. Somebody messed with the form. So.
But you could still do it.
You can do it.
You can still do it.
There's some hoops I'm not happy.
We're going to suggest that. Here's the thing.
I'm not happy.
And I'll be more diplomatic.
Hoops.
Yes, I'll be more diplomatic than he will.
I'm not.
We want your questions, and we want to help everybody. Yeah. Right now, if you go to ask a question, they're going to ask you a lot of questions you may not want to answer, which we don't want you to have to do. So that will be.
Oh wait, just
rectified.
give out your email address. They send them right to you.
No, I'm not giving up my email address.
They can find it anyway.
It's not hard to figure out, by the way.
Yeah, it's
but
really
then I
not.
get so many emails anyway.
All right. Do you have a question that was
I
sent
do.
in
I've got
in the
several.
old days
Yeah.
before the form
Yeah.
got too
Back
complicated?
in the old days. Yeah,
Yeah.
my war on trees continues. DK writes us from Glendora, California. Hi, Don and Tom. Thanks for your service to the community. I have a question on 401k contributions. Since I'm over 50, I can do catch-up contributions. Do I have to wait to fully contribute my regular contributions before I begin contributing towards my catch-up contribution bucket? What happens if I contribute less to the regular bucket and contribute $8K to the catch-up? There's no such thing.
Yeah, no, it's all the same thing. You just
Exactly,
if you're
yeah.
doing the catch up, you just up your monthly withdrawal
Correct.
from your monthly.
Yep. There are no separate buckets for either one.
No,
because I've
it's
been
all
doing
it's all
catch-up
the
for
same
decades.
bucket. I've been doing catch up
Decade.
for a long time, and I really like it on fries. I don't like it
Beautiful.
on
Yeah, I
it
sometimes
goes
go with harder. Depends on my mood.
fish
So-
sometimes. Yeah, as a matter of fact,
No, I was talking fries.
I found
Fries.
the key to the fillet of fish at McDonald's.
You found the key?
The key.
I was wondering how it disappeared
What you do
earlier.
is you customize it and you put ketchup on with the tartar. Oh, so much better.
I'd rather have a nice piece of tilapia or something. But okay, so
Dude,
back
can
to your
you get
question.
a nice piece of tilapia at a drive-through?
Not that I know of.
No,
I don't order a lot
no.
of fish through drive-thrus. No offense. So, but back
And by
to
the
your
way,
question,
if you're gonna pick a fish, tilapia.
Yeah.
That's
but for just a garden variety whitefish, sure,
it's
it's
just
fine.
farmed. It's like farm fish. You're not
It's
going
good.
to pick
You
a
can
nice
get fresh
wild
tilapia right out
salmon?
here in my lake. I think. Well, yes. If I'm
No,
coming,
those are
you
bass
know me
or
better
something.
than that. You know me.
Those
better
are
than that.
bass
You know I'm
or
gonna go
trout
with-
or something in your lake. They
you
don't
know
have
I'm gonna go with-
tilapia in your lake.
But just for what you were talking about, for like a fillet of fish thing,
Oh,
yes,
okay,
that's
see,
what you
that's
should
all
have.
good.
That's
All right.
where we had. If I'm going to have dinner, and now that you recommend it, by the way, because my daughter's going to be gone for a few days, maybe I will have salmon this week because I love, as you know, fresh piece of
dude,
salmon.
and you live in salmon country. The salmon we
Indeed
get out
we
here
do.
is that Atlantic stuff that's sort of like barely
I don't
pink.
like- it's all. Ugh. So
Yeah.
anyway, DK.
No, we're gonna
just
have to
keep
we're gonna-
putting the money in.
Yeah. Oh,
Put the
yeah.
money in.
Pretty much just put it
Yeah.
in. We answered it
That's
already,
it.
didn't we? That was
Yeah, we
so
did.
simple.
Thank you. Yeah. Oh.
But we still have lines open if you want to ask us a more complex question. 855-935-TALK is the phone number, so try it right now.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You know, during the break, I heard that Amtrak Cascades commercial.
Yeah.
You guys are so lucky in the Northwest because you are
How's
going to
that?
get the very first truly, except for the Acela, which is, the Far East train, you're getting the first truly modern European railroad cars in the country in like decades on that Cascades route. The new Amtrak Aero trains or whatever, they're brand new. They're made by Siemens and they're gorgeous.
So are these like birthing units? I mean,
No, these are the new trains. The new.
So he can sleep on them?
They're the train between Seattle and Portland.
So but you're talking about the thing inside the train.
No, the
like
cars.
The Pullman car.
They're all new. The whole train is new from front to back.
I see.
They have new engines that work on electric or diesel. They've redone the interiors. They've got bigger bathrooms.
I just don't. How often are you on a train?
I love trains. I wish I could ride trains more often. I
You
love
could
trains.
get on a train about now and be here for retirement.
Yeah, that's about how long it would take to get there.
No offense.
No,
and guess
literally,
what? It'll cost more.
I've
too.
looked at it, and it's like, okay, we go from Florida to D.C., and then we
Wisconsin.
change trains, and we go to Chicago, and then we spend
Yeah.
a day in Chicago before we change trains. It's like 5 days.
Unless you're running for office in 1932, I don't suggest it. By the way, so
No, but these new trains, I'm a train guy. I love trains. These new trains are gorgeous.
Okay, now I know what we're going to do when you come out here. We'll go on the train. We'll do it
To Portland?
if we have to. I guess.
Turn
Why
around
not?
and come back?
Yeah. If you really like the train that much. I didn't know you're such a big train guy.
I love trains. I think trains are amazing.
I would be in the sky if I
would travel by train. If we had European-style railroads, I would travel by train. I
Okay.
love it.
Well,
love it.
we
Love it.
will
Love it.
look into
I mean,
that
look at
for
me.
you.
I drive instead of fly.
That's true.
Airports
you
make
do like
me
driving.
crazy.
Yeah.
855-935-TALK. You can call questions in or you can send them in at talkingrealmoney.com. We appreciate them either way. And We talk about a pretty broad variety of topics about investing, and we also talk about not just stocks investing, not just bond investing like Mark did, but we also talk about other kinds of investing. But we're not going to do that yet because we're going to go to Denver.
Denver, Colorado, home of the troubled Denver Broncos.
Oh, they're not troubled. Their quarterback got hurt. Robin, welcome to the program.
Hi. Thank you so much for taking my call. So I called a couple of months ago, and I was taking just a small portion of IRA money out, but yet I was doing Roth conversions, and you quickly advised me that's probably not a great thing to do. Appreciate that. So I'm looking at projection out. I'm 69. My wife and I both will be taking RMDs in a couple of years. And I'm thinking, if I have excess RMD money, a lot of excess RMD money in a brokerage that rolls over into a brokerage account, can I use that to do, I can use it to do Roth conversions, but does that make sense to use that money to do a Roth conversion?
So you're going to have to take the money out and pay tax on it. There's no question about that. That's over and done.
Right.
No matter how much you take out. So what you're saying is instead of you taking it out and putting it in a brokerage account and having it in a brokerage account, instead take it out and put it in your Roth IRA. Am I hearing you correctly?
Use that excess RMD money to pay the taxes on a Roth conversion.
Oh, you're just saying, okay, I've got money after I pay taxes on my RMD. Is that right? I'm trying to decide. I'm trying to understand what excess RMD money is.
Yeah, I don't know what that refers to.
Oh, sorry. I don't need the money to live on.
Okay, got it.
So it's in excess of what you need.
Right. So you would do a Roth conversion and then pay the taxes out of money you don't need. Well, that will save you on future RMDs. But
I don't know that I'd be doing that.
I don't know that the savings are going to be worth the loss of the.
I see what he's saying now.
Yeah, because remember, the money that you're using to pay the taxes is money that could be making you money in your brokerage account.
Instead of giving it to the government.
Right. You'd actually have to sit down and do the math based on your tax situation, what the expected return might be on that money. And the differences, I am confident, are going to be so small as to make it almost not worth bothering.
What bracket are you in?
Yeah.
Do you know?
Are you in a high tax bracket?
22%.
Yeah.
22%. And then, but in the excess amount of the RMD is going to be in the range of in excess of $50,000 a year.
Yeah, but it could sit there in your brokerage account making money.
Yeah. True. But I'm paying tax on that capital gain.
But here's the thing. I think you're way more concerned about taxes. And you've got it's a balance between what the tax liability is and what the returns might be. And having done this several times, we find that unless you're in a very high bracket, that the difference, they don't, at this point in your life, because of the lack of time to really let that grow, the differences to you, bottom line differences, are likely to be tiny.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You know, taxes are a big deal.
Yeah,
I
was thinking about Rob during the break, and a partial, maybe little baby conversions might
you can do some of it. Yeah,
might make sense, but you got to be really, really careful. You got to make sure it's not going to kick you into a higher bracket.
That's one thing, but the other thing, really, at the end of the day, because one of our advisors was on with somebody, and I'm lucky to sit there and listen because he's so bright. He pointed out that the Roth for most people, end up being an estate planning tool. That's money you're unlikely to spend, you leave to others. If that's truly what you want to do and you want to leave them tax-free money, okay. I've said this publicly. If I leave my kids money and they got to pay tax on it, get over it. It's free money.
That's
money.
My take. Exactly. And the fact is, we rarely take into account the lost revenue from the money that we're giving to the government, because
it's no longer. And there used to be a thing. CPAs used to say, "Don't pay any tax till you have to." Remember that?
Pay no tax before it's time.
Exactly.
I think that's a
we will be
paraphrase.
talking about taxes at Retire Meet. I know that, among other things.
You're getting into
I
the
love your ads.
promo really soon.
Yeah, because here's the thing. You guys are making me look bad. I told everybody to be sold out by now, and it's not.
Yeah.
So I
it's not.
overpromised.
He does look
and
bad.
looking
I mean,
bad.
he has been
I do
catching
look bad.
real
Look at my hair. Barely
H-E
shaved.
double
I just look
hockey
horrible.
sticks. He has been catching it.
From all sides, by the way.
All
People
sides,
write me
because
from everywhere.
his prediction was, oh, yeah, Retire Meet will be sold out the first week of February. It's
Yep.
not. It's not. It's
Second
close.
week, no, it's close. So if you want to join us, we'd love to see you. That's 3 weeks from today on Saturday, March 7th. Somebody wrote me yesterday and said 2 weeks. I said, wait, 2 weeks? I think it's 3 weeks.
3 weeks.
Yeah. But we'd love to see you there. It's a great event. And we do really, truly have gifted speakers that cover a variety of topics. It's an educational day, but it's a fun day too. So that's at the Maidenbauer Center in Bellevue. Yes, tickets are still available, so get those tickets now at retiremeet.com, MEET.com.
Yeah, retiremeet.com. But to finish my thought before for the Roth IRA thing, the other thing you have to take into account is that crazy woman IRMAA.
Oh, huge impact.
Yeah,
Yep.
man, because these days with premiums on Medicare, I mean, they've skyrocketed. IRMAA,
pay a lot of money.
I ran some IRMAA numbers for me down the road, and I'm not on Medicare yet, but whoa, very expensive if you...
Wait, did you just say you're off your medication? You're not on medication right now? You should be.
I said I wasn't on
that,
Medicare. Okay.
Oh, Medicare.
I was wondering
Okay,
what you were
good.
talking about. See, the
Okay,
joke
scared
was
me.
so bad, it took me like 30 seconds to even realize what the joke was.
I'll take 30 seconds. Usually it's a minute, so that's
Okay,
good for me.
so it was a new record. Yeah.
Exactly. Anyway, IRMAA, yes, consideration. And yes, we will be talking about IRMAA because we have Kevin from our Medicare people. He'll be there chatting.
You don't remember the name of his company, do you? Neither do-
ASR, ARS,
Yeah.
JRS, I apologize.
Is
I'm
it like
gonna
American
say sorry.
Retirement Services or something?
It could be. So he's
don't
wonderful.
know.
He's wonderful. That's all I know. We get
Their other
great
name was
comments
much more
on him.
catchy, whatever it
I
was.
know. I know. So we're sorry, Kevin. But he'll be there speaking. He's come, I think, every year. He's one of the highest
and
rated
I
every
have
year
to
'cause
tell
people
you,
love it.
truly, God, I hate using the word, but as a senior, I just do not feel like a senior. Is it just
I
me?
did today when my knee was hurting. Yes, I did.
Okay, my knee hurts, but I'm like
1 minute.
I'm thinking I'm still.
No, I still have many immature thoughts. If
yeah,
that's what you're
I still have
suggesting. Yeah.
terribly immature thoughts.
Of course.
Just
That
ask my
comes from
wife.
mine.
Take my wife.
Leave it there. It's Valentine's Day. You're okay to say that stuff on the air today. So,
Yeah, it's all right. I sent her some
Yeah.
flowers.
me too. Not your wife.
You
My
sent my wife
wife's
flowers?
I
I
love
wonder
your
who
wife.
those
You know
came
that.
from. Yeah,
You know that. So
I was curious about that.
send my love to her. She's the best.
She's the best. Yes, she's a
Yes, she
she's a
is the
good
best.
soul. And
She is.
if you have questions for us, just send them in at talkingrealmoney.com
Wait,
or
I didn't
call
finish the
us.
Retire Meet thing.
I thought you were done.
RetireMeet.com. I didn't get the chance to.
You
RetireMeet.com.
did.
Sign
I
up now.
swear you said retire
Please get me off the hook. Just get a ticket, would you please?
Yeah, you just buy pity tickets. You don't even have to show up. Just buy pity tickets.
We'll send your lunch to you. Don't worry.
Just go to retiremeet.com and just buy a ticket because you feel guilty because Tom made you feel bad. Talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.